What's up, guys? Mike Sharp here. This is Sharp Investing, and this is REAX, the Real Brokerage. Now, I think housing in the US could be set up for a boom in 2026, and I think this is a pretty interesting way to play it, as it has asymmetric upside and has a confluence of factors that could lead to an explosion to the upside. Now, keep in mind, I haven't finished researching this yet. I don't own it. But I started looking at it on Monday and I thought this is pretty interesting, and I'll probably deep dive into it. And I may do another video once I get through it. But I wanted to give you guys a high level view of this because I think it's pretty interesting. And if anybody out there has info on it that they want to share, please feel free to in the comments. All right, so why do I think there could be an explosion in real estate first off? Well, I think that since 2022, when the Fed raised rates to 5%, which led to mortgages over 7% in the US, there has been a whole bunch of pent-up demand, which has been sort of piling up, right? So you have all these people who are locked into these really low-rate mortgages, these 30-year low-rate mortgages at 2% or 3%, and if they were to move, then they'd have to get a mortgage at 6.5%. So people end up being locked into their house, even if they want to move a lot of the time. And on the other side, these high rates deter new people from getting into the market and paying these high prices, right? So you have a really, I think this industry is actually in a recession and has been for a long time. And I think that our friend Donald Trump is about to unleash the pent-up demand. Now, he is he's pretty convinced that they need to lower rates. And I think that I've learned over the years, do not bet against Donald Trump. He usually gets what he wants. So if he wants rates down to 2%, I think he's going to find a way. Come hell or high water, he's going to get them there. Remember, Jerome Powell's term is up in May. And at that time, Trump gets to appoint whoever he wants as the Fed chair. And then all bets are off. Now, he's trying to push it before then, right? He's replaced somebody on the board of governors. He's trying to kick somebody else out. I'm sure he'll keep trying to make moves to influence their policy and get rates down. But and right now they're resisting, but I think there's only so long they can hold out. So if we get rates down to 2% and he finds a way to get long rates down as well, then that's going to unleash all this demand on the housing side. Okay, so what's REAX then? How do they fit into this? So REAX, the Real Brokerage, is a disruptor brokerage in this dinosaur industry of residential real estate brokers, right? So in their words, they're a software-based real estate brokerage that provides agents with the ability to earn more money with more autonomy and more advanced technology. They're a high-value, low-cost offering. Their high-value, low-cost offering attracts agents who are passionate about building their business. So in real estate, this is very much a top-end heavy industry. So the top 20% of agents achieve 65% of roughly 65% of the sales in the industry, and you have all these low-level agents that don't make a lot of sales. People see there's low barriers to entry to be a broker. So a lot of people get into it and they aren't able to get any traction. But these top 20% is where the revenue is driven from, right? And so REAX has a model that I think attracts a lot of agents because it allows them to keep a lot more of the revenue that they earn and the commissions they earn. And I'll tell you why. There's a whole bunch of things that lead into that. But the bottom line here is I think REAX is a very attractive model, and they're showing that via their growth rates, right? So just some high level numbers. The sector had over $3 trillion in gross sales. That includes the value of the home sold. And the brokerage revenues in the US were over around 200 billion. I got a few different numbers, but they all seem to be around 200 billion. So it's a very big industry. This is a huge TAM market for REAX. And right now their trailing 12 months revenue was 1.6 billion. So they're less than 1% of the revenue in the industry. But they're growing extremely quickly. That 1.6 is up 4x since 2022. That's the trailing 12 months revenue after Q2, right? So they're growing very, very fast despite this sector that's actually in what I would consider a recession, right? So if you're able to grow that quickly while your sector is in the toilet, like that's a pretty good sign that you've got a business model that's worth looking at, right? So my idea is if we actually do get the housing boom, you're going to get a huge number of things that lead into this company doing well, right? And again, I'll get into that in a bit. But let's talk about this from the agent's perspective. So if you're a real estate agent, why would you move to them? Okay, so let's do a little comparison. The commission split for a traditional brokerage is anywhere from 50% or 20% to 50% goes to the brokerage, and the agent keeps the rest. But they have these other fees on top, which we'll look at, right? So the Real Brokerage is an 85-15 flat split. They only pay 15% to REAX, and the rest the agent gets to keep. Now there's a commission cap as well. REAX has a 12K commission cap. So once you've paid them 12K, you get to keep your commission rate goes up to 100%. Whereas the cap in other brokerages is anywhere from 20 to 28,000 and sometimes even higher. Now there's these things called desk fees, right? So in the traditional the dinosaur brokers, they have these office spaces and the agents have to pay them, right, to use their space, right? So this can be anywhere from $250 to $1,500 a month. That's on top of the commission split, if it's not included. Sometimes, like if it's a 50-50 split, this stuff is included. But for the high earning agents, which actually they can get a better revenue split, commission split, if they're a high earning agent. It could be like a 90-10, but then they'll have these desk fees on top of it, which knocks that back down again. Whereas REAX doesn't have desks, so they don't have a desk fee. Other fees, both of them have charges. There's brokerage fee, post cap split, transaction fee, initial startup fee, and then insurance and compliance fees. And so those are somewhat comparable. Basically, the big numbers, REAX is definitely winning on those, right? So, and this shows up in the growth of their agents. They've gone from 6,700 agents 3 years ago to 29,000 plus now, right? So they're growing leaps and bounds, and a lot of these agents are obviously attracted by the financial structure, but there's also incentives put in place to recruit new agents for the agents that are already there. So you can see there's a lot of people who are recruited via other agents. On top of this, if you're an agent, they have this platform called Rezen. This is their software offering, which has CRM, transaction management, marketing tools. It's a community, so you can connect with the rest of their brokers, and so they can exchange information and learn from each other, right? So that's pretty useful if you're an agent that is new or wants to learn other things. They've also added a thing called Leo Copilot, which is an AI assistant for these agents. It finds errors in the documents. It says, oh, there's missing signatures here. Maybe you need to do this. And then it gives you marketing help as well, plus a whole bunch of other things, right? So they have this customized AI agent that the real estate agents can use, right? So these are all huge value adds compared to some of the older, bigger, more stodgy companies, right? Now, here's another one that I love. The agents can become shareholders in this business, and that creates a lot of stickiness with the offering. So people come in, and then there's all these ways to earn shares and buy them at discounts so that you can be invested in REAX as well. And that's sort of I don't want to say flywheel, but it's kind of like that, right? So you get shares, and then that gives you extra incentive to go find other agents and bring them aboard, because that's going to help the business, which is going to help you because you own shares. So I'll go through some of the ways you can earn shares here, right? So they have a stock purchase plan where you can buy shares out of your commission at a discount from market price. So you instantly make money there, right? They also have a restricted stock units you can buy, which are a 1-year vesting period. There's performance bonuses where you can earn up to another $16,000 in shares and another 8,000 in restricted share units. You can, like I said, if you attract agents, other agents, you can earn more shares on the referral, plus you get an override, a cut of their commissions, right? So you can build a passive income stream as well if you attract people to the business, right? So all of this stuff makes this offering really sticky to these agents, and they might not just bounce around from the agencies trying to get good deals, right? So if you think of it from your perspective, if you were an agent, does this sound good? To me, it sounds quite good, actually. Now, the downside to this is it leads to high dilution in the shares because they're issuing a lot of shares to their agents. And from an accounting perspective, those share costs come out of cost of goods sold, so which is part of the reason it leads to this quite low gross margin. So don't get grossed out by the gross margin just yet. But you know, like I think looking back to 2021, the dilution is about 5% per year, give or take. But I think it's a great deal because you're using these really great ways of incentivizing your staff and keeping them in the business, and that has led to a 13x revenue growth in that period of time since 2021. So 5% dilution per year equals 13 times revenue growth. I think that's a good deal. I would take that all day long. Okay, so key data, some key numbers here that I'm looking at. Agents, like I said, they're up to over 29,000, growing massively, growing 4x in the last 3 years. The balance sheet is clean. I'm not going to talk a lot about the balance sheet, but they got $100 million in cash, no debt. And, you know, like this is not a balance sheet investment because the value of the business, the intrinsic value, is not on the balance sheet. It's in the brand and the stickiness to the agents and the efficiencies they have versus the competition. So that's not going to show up in the balance sheet. So if we look at the income statement, last 12 months revenue is up 4x, like I said, since 2022. It grew 83% last year. It's down a little bit this last 12 months, but still really high growth rates. The gross profit is not improving. It's about flat. So they're at 9% gross margins. So that's, you know, obviously very low, but there's some ways that they think that they have to improve this number going forward. Again, that's up, you know, kind of in line with revenue, right around 83% in 2024. And, you know, that's fine. Now, there can be operating leverage here. There has been some recently. The OPEX is growing. It was up 47% in 2024, but that is lower than the growth rate in revenue and gross profit. So it's dropped the OPEX percentage of revenue from 7.4 to 5%. I think it was like 4, and I think that's in the last 12 months number, and most recently it was at 4.2%. So there is operating leverage that's sort of taking effect here. And yeah, I think it could get a little bit better as we go forward. Now, just some valuation numbers. Price to EBITDA, the 12-month EBITDA number is about 50 million. Enterprise value is about 700 million when you take the cash off the market cap. So that's about a 14 times EV to EBITDA. Not bad, pretty good for this level of growth, right? If you're getting 80% growth for a 14x multiple, that's pretty nice. Price to cash flow, free cash flow is 67 million, is actually higher than EBITDA. If you just use their figure free cash flow, 67 million versus 800 million market cap, that's a 12x. Now, I should say that they're doing that clever thing where they issue shares and then the share issuance doesn't count as part of operating cash flow. So the cost of those avoids the free cash flow figure. If we look down the cash flow statement, there was last 12 months was about 34 million in buybacks that they had to do to cover some of that share issuance. So if we take that number out of the free cash flow number, then our multiple drops to about 24 times price to free cash flow. Again, not bad considering the growth rate and the upside potential here. So price to sales, 1.6 billion in revenue, like I said, 800 million market cap. That's at 0.5 price to sales. That's pretty nice. Now, the path to higher margins is mostly in ancillary revenues. They're building other offerings that they can do. They're like, for instance, their title service, that is 80% gross margin. So as they grow that segment, the gross margin number should go up. They have consumer-facing products that they're starting to add now, mortgage services and other services, and those gross margins can be between 45 and 50% gross margins. And they also have this thing called Real Wallet, which is a digital wallet for their agents, helps the agents get paid faster. I think they offer a line of credit with it as well. So there's other offerings that they're building in. They're spawning new ideas and continuing to grow and look way out into the future, which I really like. So if they can make these work and have a more holistic offering to their customers and their agents, these gross margins should improve over time, right? So bottom line here, the summary is, I really like what I'm seeing here. I don't think that real estate agents are going to be AI'd away anytime soon. So I think this is a pretty good industry to look at the moment, especially with the Trump trying to run the economy super hot by lowering rates and pump nominal GDP to sort of delever the balance sheet of the government. That sort of seems to be the plan. It looks like he's going to get his way, and once we see those 2% rates or 3% rates, that should provide a big boost to the housing sector in the U.S., which, like I said, has 2 to 3 years worth of pent-up demand in it. So I think, again, great model for attracting and retaining high-performing agents. The agents are the revenue engine here, so they're the most important people here, and the numbers speak for themselves. These guys are doing a great job of attracting more and more agents and growing revenue in a recession. So if they can get the margins up via operating leverage, so the operating leverage will kick in, the ancillary high margin offerings, and on top of that, they're still growing fast. Generally, these three things could lead to a massive explosion to the upside here if they get this formula correct, right? And again, it's not that expensive right now. I wouldn't say it's cheap. It might be cheap compared to the growth rate if you use a PEG model, which I like. But in a vacuum, if you just look at the multiples, it's okay. 14 times EV to EBITDA and 24 times free cash flow. It's not bad. So I'm going to keep looking at this one. I think this is super interesting. And yeah, if you have any comments, again, please post them, and I will see you in the next video. Thanks, guys.